Have you noticed something strange happening in the US economy lately? Legendary investors like Warren Buffett, often called the Oracle of Omaha, have suddenly seen their profits plunge. Buffett's Q2 earnings dropped by a staggering 60%. When even the best can't make money, what does that say about the market? Yet, after the April stock market crash, the US market bounced back sharply, returning to new highs. So is the market really struggling? Or is it that even Buffett isn't as magical as before? Some say he's retired, sipping Coca-Cola instead of fighting on the trading floor. But don't just laugh at Buffett. Other Wall Street giants like Jim Rogers, Ray Dalio and Jamie Dimon have all sold off their US stocks. They missed the chance to buy back when the market was down 20%. In fact, many big players have been outperformed by retail investors recently. So what's really going on here? Let's talk about a crucial indicator, the non-farm payrolls NFP report. The Federal Reserve watches this number closely when deciding interest rates. Normally, adding over 100,000 new jobs each month signals a strong labor market. Below 100,000 means trouble, rising unemployment, and a weakening economy. Looking at the data, May and June seemed great, with around 140,000 new jobs added each month. Everyone cheered. The labor market was booming. The economy was strong, but July's report told a different story. Only about 70,000 new jobs, half of the prior months and below the 100,000 mark. Still, that didn't seem too bad, right? Here's the catch. The earlier numbers for May and June were heavily revised downward from 140,000 to just around 10,000 jobs each month. Imagine that. In reality, May's job growth wasn't 144,000, it was closer to 19,000. June wasn't 147,000, it was barely 14,000. July added about 73,000 jobs. If you think July's numbers will hold after revision, think again. This means for 3 straight months, job growth in the US has been far below expectations. The government even admitted to fudging these numbers and fired the head of the statistics department in charge. What does this tell us? That the strong labor market we saw after April's crash was an illusion fabricated to keep confidence high. Now that the government has fired the official responsible, it suggests the charade is over. The real economy may be far worse than the fake numbers showed. So did Buffett, Dalio, Rogers, and Dimon lose their touch? Or were they just playing along with a rigged game, waiting for the right moment to strike? When the music stops, will you have a chair? In life, karma always comes, sometimes just later than we expect. Let's talk about the US debt situation, which has now reached nearly $37 trillion. Recently, after Congress approved the debt ceiling increase, the government immediately borrowed close to $1 trillion. On the surface, this means the government has an extra $1 trillion to spend. But where does that money actually come from, and how does it affect the market? The Federal Reserve Fed doesn't just print new money or lend directly to the government. Instead, the government borrows from the financial markets by issuing treasury bonds, especially short-term bonds. Here's where it gets interesting. Imagine you buy $1 million worth of short-term treasury bonds that mature in 1 year. After 1 year, the government will pay you back the $1 million plus some interest, say $50,000. Normally, you'd hold on to these bonds until they mature to get your full return, but some investors don't want to lock up their money for a year. Instead, they use these bonds as collateral to borrow money from banks. Banks see these treasury bonds as virtually risk-free collateral. If the investor can't pay back the loan, the bank can sell the bonds and recover the money. So banks happily lend out most of the bond's value, say $950,000, to the investor. Now here's the key part. The banks don't just keep that money idle. Effectively, with just $1 million invested in treasury bonds, investors can access nearly $2 million in cash by leveraging this chain of borrowing and lending. What does this mean for the market? Even though the government borrowed $1 trillion, the money doesn't vanish from the market. Instead, it gets recycled through banks and investors multiple times, amplifying the amount of money flowing. This is why, despite the dollar weakening recently, markets haven't crashed due to liquidity shortages. This financial leverage, sometimes called a leverage fund strategy, is essentially creating money out of thin air by repeatedly borrowing against safe government debt. Investors using this technique can multiply their returns dramatically. For example, if $1 million in bonds earns $50,000 interest annually, leveraging that 20 times could theoretically earn $1 million in interest. This is how the government manages to borrow huge sums without causing immediate market panic, and why there's so much cash sloshing around even when the dollar is weak. but it's also a fragile system. If confidence drops and investors start selling off bonds or calling in loans, the whole structure could unravel fast. Now let's look at a curious and critical relationship: the US stock market and the US dollar. At first glance, you might expect them to move together when the economy is strong. Both stocks and the dollar should rise, right? But that's not always the case. Since the start of the year, the dollar index, which measures the dollar's strength against other major currencies like the euro, yen, and ringgit, has actually weakened. Meanwhile, the US stock market has rebounded strongly, hitting new highs after the April crash. Why is this happening? If the economy and stock market are booming, shouldn't foreign investors be rushing to buy dollars to invest? Shouldn't the dollar be strengthening? Let's consider the global flow of money. When foreign investors buy US stocks, they need to exchange their local currency for dollars. So strong stock buying should push the dollar higher. But recent data tells a different story. Despite the rally in stocks, more investors are selling dollars than buying, pushing the dollar index lower. Why? One reason is that some big economies like Japan, Europe, and South Korea have pledged huge investments into the US, but the dollar isn't responding with strength. It's as if the money isn't actually flowing in as expected. Another factor is the huge government debt and new borrowing. Last month, the US government borrowed nearly $1 trillion more by issuing short-term bonds. Normally, issuing this much debt would raise interest rates and boost the dollar, but the dollar keeps slipping. Here's the catch: the government's strategy of borrowing short-term bonds and the financial leverage cycle we talked about earlier are creating a kind of illusion. There is plenty of money in the system, but much of it is borrowed or leveraged, not real capital flowing in. This means the stock market can be artificially supported while the dollar weakens, a sign that the market is being propped up by debt and financial engineering, rather than fundamental strength. Now think about investors from abroad. If you're from Taiwan, for example, and you buy US stocks with your local currency converted into dollars, but then the dollar falls 15% against the Taiwan dollar, your investment has already lost value before you make any gains. You'd have to earn at least 15% just to break even. The same applies if the dollar weakens against the euro or ringgit. This currency risk is a hidden danger that many investors underestimate. They see the stock market going up and jump in, ignoring how exchange rates might erode their profits. Here's where things get tricky. We've talked about the government using short-term borrowing and banks leveraging those treasury bonds to pump liquidity into the system. We've also seen the dollar weakening while the stock market climbs. Now let's put it all together. When the dollar weakens, it creates two major risks. 1. Foreign investor trap. If you're an international investor, say from Europe, Japan, or Taiwan, you buy US stocks using dollars. But if the dollar drops 10 to 15% against your home currency, you've already lost a chunk of your investment just from exchange rates. That means even if the S&P 500 gains 10%, you might still end up negative in your local currency. And it's not just foreign investors. US-based investors with exposure to imported goods, international businesses, or overseas operations also feel the pain when the dollar slides. 2. Fragile financial leverage. Remember the leverage cycle. A single $1 million treasury bond can be pledged and repledged to create almost $20 million of liquidity through repo agreements. This is powerful, but it's also dangerous. If bond values start dropping or if confidence in the system cracks, the chain of borrowing collapses. That's what happened in 2008, when the repo market froze and liquidity vanished overnight. This time, the risk is even higher because the scale of leverage is larger than ever before. Add to that the massive US debt, now near $37 trillion, and the constant need to roll over short-term bonds. If foreign investors ever lose trust and stop buying treasuries, the entire system could face a liquidity shock. So what's the hidden danger? The illusion of endless money comes from leverage and debt recycling. As long as everyone plays along, the system works. But the moment fear enters the market, whether from a bond sell-off, a spike in interest rates, or a sharp dollar move, the dominoes start to fall. That's why many analysts quietly worry about a sudden, violent adjustment rather than a slow, predictable decline. So, what does all this mean for you as an investor or someone worried about your financial future? The bottom line is this: the US economy and stock market right now are not exactly what they seem. Government data, especially on jobs, has been manipulated to paint a rosier picture. Massive borrowing and financial leverage are inflating the market artificially. The US dollar is weakening, which adds currency risk, especially for international investors. The system is fragile and could face sudden shocks if confidence breaks. This doesn't mean you should panic and sell everything. Instead, it means you should be smart and strategic. Here's what I recommend. Don't blindly hold stocks long-term without watching the bigger picture. Even companies with strong fundamentals can be caught in a market crash caused by broader financial forces. Develop a clear investment strategy that includes risk management. Focus on spotting trend reversals and use compounding gains wisely. Understand the currency risk if you invest internationally. Gains on paper can evaporate with adverse exchange rate moves. Diversify beyond US stocks. Consider assets like gold, Bitcoin, or other currencies that might hedge against dollar weakness. Stay informed and critical of official data and news. Question narratives and look for the underlying truths. In short, mastering your financial destiny means being aware of these hidden risks and preparing accordingly. Wealth Cipher warmly welcomes all of you. Be sure to follow the channel so you never miss any valuable information that will help you take control of your financial destiny.